So with that out of the way, let us get started. And I would like to start by first introducing Mr. Syed Muhammad Umair, who is the SVP and Head of Wealth Management at Emirates Islamic. Syed Umair manages the bank's largest deposit portfolio, being its private banking and priority banking segments. And he sets out with his team the strategy for the Sharia-compliant wealth management strategy for the bank's high net worth, affluent, and emerging affluent customers across the UAE. So without further ado, I would like to hand over to Mr. Syed Umair to deliver his opening remarks. Syed, over to you.
Thank you, Mustafa. Assalamu alaikum, everyone. Good afternoon. Ramadan Kareem to everyone. It's my pleasure to host all of you who've been able to join this webinar event. In light of what the difficult situation we've been going through for the last 2 months, approximately, I think our philosophy in our business has been that during these difficult times, our role needs to be that we need to be closer to our customers by being in regular touch with them and also guiding them through what the turbulent times have been in the global markets for their wealth management strategies or portfolios. And as such, how we can advise them to be able to navigate these challenging times. And in light of one of those objectives, we had organized this webinar to be able to share with all of you what are our thoughts, what are our recommendations. Our team from Emirates NBD's Chief Investment Officer team are here, and they'll share with you some of their insights and approaches, what they recommend. And at the end of the day, I hope that this event will be useful for all of you. And we will take a cue, and the learnings and your feedback will be very important for us to tailor such interactions with you as we go along, because it's clear that the old way of doing business may not come back as quickly as we hope. So in line with adopting to the change what we're going through, one of our key philosophies is to be a more digitally focused environment, a more digitally focused bank, but at the same time being very close to our customers. And as such, we'll use these events more frequently, or this format of events more frequently, to be interacting with you and to be able to share with you our thoughts and insights. So without further delay, thank you very much, everyone, and I hope this is insightful for you, and I'll hand it over to Maurice from our CIO team. Thank you.
Thank you very much, Umair, for those opening remarks. And I think you really hit the nail on the head when you mentioned that this is the time where we need to be closer to our clients. Our clients are facing a lot of uncertainty in the market, and they're looking for advice, they're looking for guidance, and they're looking for a partner that can work through that with them. And it's very heartening to see Emirates Islamic and Emirates NBD Group taking these initiatives to stay connected during these difficult times. So we will now move on to the presentations, and I would really like to take this opportunity to introduce our panel of speakers for today. And we're very privileged to have the investment team from Emirates NBD Group, led by obviously Maurice Gravier, who is the Chief Investment Officer at Emirates NBD and has over 20 years of investment experience with leading international asset managers, private banks, and family offices. His presentation today will focus on the global investment outlook and context for the rest of the sessions. We will then be joined by Ms. Anita Gupta, who is the Head of Equity Strategy for Emirates NBD Group CIO Office. She has over 30 years of investment experience built across asset management, proprietary trading, and wealth management. And she will be sharing insights on equity strategy for investors in the current environment. And finally, we will be joined by Satyajit Singh, who is responsible for fixed income strategy at Emirates NBD Group CIO Office. He has over a decade of investment experience with international banks and trade rating agencies, and he will be presenting on fixed income strategy. So let's kick things off. And I think before we move to our first presentation, I would like to ask the host to open up the first polling question. And you can respond to the polling question from the screen on the right. And our first polling question really talks about your perspective for the performance of what you think a moderate portfolio will perform this year. And we've given you a reference point. The performance of a moderate portfolio in 2018 was about -4%. In 2019, last year, it was positive 14% and really performed well towards the end of the year. So we want to get an understanding of what you think the performance will be. Is it going to be a very, very challenge? I mean, we all assume it's going to be challenging here, but will we bounce back or not? Will we have negative double-digit decline in a moderate portfolio, in the performance of moderate portfolio? Will we see some consolidation later in the year, the decline being somewhere between 0 to -5%? Will it be flat, close to 0%? Will we see a modest gain, perhaps in the next few quarters of the year? Or for the extremely optimistic audience members amongst us, do you expect that it could possibly go into double-digit growth for this year? So I would ask you to please submit your questions. And I think once the timer is done, if we can have the organizers please put up the results of the questions on the screen. And we can see what the audience's perspective is on the performance for a moderate portfolio in 2020. And the poll, I believe, has ended. And if I can please ask the host to put the results of the poll on the screen. And there we have it. I think nobody is really expecting double-digit growth, but I think it's relatively evenly split. The vast majority of people, about 21%, expecting some consolidation, but the year to still close at -5%. Another 19% expected to be, less than -10% or worse, and about 11% expecting it to be flat, and 14% expecting a modest close with some recovery in later quarters. I think that gives us excellent context into what Maurice is going to be touching upon, and some food for thought for him as well, as he tries to talk about, as he mentions, the global investment outlook for us. So with that, Maurice, I'd hand it over to you to begin your presentation.
Thank you very much, Mustafa, and a warm welcome to you all. I will just take the hand on the slide. Let me tell you that it's the first time that we're hosting this event in this format, so we are delighted to do so. Thank you, Sayed Umair and Refinitiv for it, but please understand that we are beginners, so I hope it's going to work fine. Today we'll speak, of course, about our key views for 2020 in this very particular context, but as this event also replaces our traditional year-ahead event that we couldn't hold in February, I will start by quickly telling you, we always do that, what we have said in 2019 and what happened. So let me go directly to that. Again, take the slide. So 2019, I will be quite quick on that, but we started 2019 with some concerns on the decade that we felt could be difficult, but we were constructive for the year. We were positive on equities, on gold, on emerging market debt, and we thought that rates were too low in government bonds. So what happened? What happened in 2019? Looks like it was ages ago, but it was a fantastic year. Equities were up 28%, gold was up 18%, emerging market debt and Saqqaq did better than developed markets counterparts. We were just wrong on our view on rates, which were lower because central banks unexpectedly cut rates. It was 2019. Of course, in that context, we had fantastic performances. There is no other word. Double digit, our three profiles, cautious, moderate, and aggressive, were up 11, 14, and 18% in 2019. It was, of course, great numbers in absolute. Now, was it better than our competition? Because, again, we always want to be very transparent and compare ourselves. Actually, it wasn't. If we take our international competition, our numbers were similar. And to tell you everything, it is our aim. The way we do wealth management in the ENBD group and in Emirates Islamic is that we think that we have to protect your capital better in difficult times and be as good as others when markets are good. So that's why on this chart you can see in 2019, compared to international competition, the Morningstar category, we were in line with them, but in more difficult 2018, we did much better. And that's what we want to do. So 2019 was done, 11, 14, 18, fantastic numbers, and a bit too much. That's how we ended the year, because on this slide, if you can see it, it is our strategic asset allocation. Let me spend 20 seconds on that. You know your investment profiles. When you discuss with your relationship manager at Emirates Islamic or ENBD, you will end up saying, oh, you are cautious, moderate, and aggressive. What does it mean? For us, we build this mix of optimal assets to protect your capital. For us, a cautious, moderate, aggressive won't lose money on 3 years, 5 years, 7 years. That's what we want to do. And under this condition of capital preservation, we will deliver the best possible return. And we quantify it, and that's where I wanted to go. Our quantification, our estimates for what you can expect in the long term for this profile are 4, 5, and 6%. So last year with 11, 14, and 18, we told ourselves maybe we've been a bit too fast. That's why our global investment outlook for the year was titled Back to Reality. We were expecting markets to come back to the reality of fundamentals and to be less good. But what we were not expecting was, of course, that the COVID-19. Unexpected, immense pandemic and still not over. So you know the numbers as we speak, 4 million people in 200 countries have been infected. Very sadly, 300,000 people died from this disease in the world. Up to 3 billion people have lived under social distancing measures, including all of ourselves and including ourselves today in a way. The impact on the economy has been simply the sharpest collapse ever. In Q1 alone, in annualized rates, the global economy, the GDP, has lost 12% in annualized rate. It had never happened before. It will hopefully also be the shortest, and we'll talk about that with recovery, which is expected. But unexpected virus spreading exponentially in the world, huge economic impact, so of course, huge response from policymakers, and this is very important. Policymakers around the world had to do two things. First, they had to prevent a financial crisis to come on top of this healthcare and economic crisis. That's why central banks have printed trillions of US dollars at an unprecedented rate. They have done more in 1 month. They have done 2 times more in 1 month than what they had done during the whole global financial crisis back in 2008, 2009. Massive response. First, to provide liquidity to banks, to the economy, to avoid a financial crisis, to markets as well, but also to provide governments with cheap funds so that they can mitigate the impact. The idea being that you have to avoid irreversible damage being done to the economy, which is permanent job losses. Of course, market impact has been sharp as well. As you can see, hopefully on this slide on the right side, global markets have started to overlook and ignore a bit the pandemic. And to be very honest, and we are honest, ourselves, back in January, we were a bit underestimated this Chinese virus, which was breaking out in Wuhan. We had never heard about Wuhan. But then suddenly when markets realized that it was a global pandemic, that it was an issue, markets lost 30%. 30% in 3 weeks. It was the sharpest fall since 1929, the Great Depression. We had never seen such a drop. But after that, as you can see, again on the right, when the response came, markets recovered. And they are kind of drawing the V, I don't know if you see me, I'm drawing a V, which is what we hope the shape of the recovery will be, the V of the victory on the virus, but for sure we also have volatility, many Vs everywhere. On the left side, you see where we are now at the end of April, the performances year to date. It's not good, of course, only the most defensive assets, gold or cash, are positive, but it's not desperate. You see, global equities are down 12%, emerging markets 17%. It's not nothing, but after the performances of last year and given what happens, it might look a bit reasonable. So, what to expect? This slide is a bit complex because we wanted to keep the messages that we sent out in January. Because again, we are responsible for what we say. We won't change our mind all the time. There are 3 parts. The long term, simple. Nothing has changed. We keep on thinking that our long-term asset allocations work. You should not try to time the market. It doesn't work. It's impossible in the short term, and you should be diversified. Bottom part, your portfolio. I will let my colleagues tell you in which themes, segments, and securities invest. I take care of the one in the middle, which is what to expect this year, how to position. 2020, we had 3 messages. First, expect moderate return. We expected 4 to 6% positive before the virus. Now we expect mid-single digit negative performance, anything between -2 and -8% for our profile for the year. That's our expectation, and that's the only thing that we have changed in our conviction. Second message, be flexible. We were expecting and still expect and see volatility, and when you are a long-term investor, volatility gives you opportunities. Third message, favor emerging markets. This is a long-term conviction for us, but it's as true as ever now. So let me come back to the first message, the one we have changed. We expect mid-single digit negative performance. What do we need to have markets recovering? We need three things. First, we need the pandemic itself to be under control. That's the only real catalyst that we all need to see the economies reopening, people resuming normal life and work. Second, we need the policy response to be big enough to bridge the gap between now and the normal life, and we think it's going to happen. But third, and that's something that many people forget, we also need markets to have a reasonable valuation and to take into account the risks and not only the perspective of a huge, strong recovery. So let's start with the pandemic itself. Where are we? Of course, the pandemic has started in Asia and then it moved to Europe and then to the Americas. So it's interesting to see where these different places are now. It all started in China. So the impact on Chinese GDP, Chinese economy in Q1 was absolutely huge, minus 34% in annualized rate. The good news is that the recovery has started in March in China. We are positive on the economy in China for March, and it accelerates in April. We have seen a huge positive surprise on China's exports numbers in April. Yes, the export, it was up 3%, while everyone was expecting a double-digit drop. It gives us hope. It shows that you can live with the virus and that you can escape. Now, Europe in the middle was hugely affected in Q1 because in March everything was closed, and so was it in April. So the impact will be on Q1 and Q2, but it is reopening. That's the good news. We've had Germany, Austria, Sweden reopening gradually for weeks. This week we have France, Spain. The UK will start lifting some restrictions from Wednesday. So it's happening. Then the US, the largest economy in the world. The peak of the pandemic has probably not been reached yet, but there are huge pressures to also reopen the economy. Interesting example, today you might have seen that Tesla's chairman and founder, Mr. Elon Musk, has decided to reopen its factory in California, even if the rules of the lockdowns don't allow for it. He said, okay, arrest me, I don't care, we will reopen the economy. And that's what is happening. So that's why on the pandemic itself, we know that lifting the restrictions will mean more infections, but we think that it is what is going to happen. And our assumption is for most of the restrictions being lifted for the summer, we said, and it's happening now. April should have been the worst month of the worst quarter of the last 50 years, and we think that from there we will have a recovery. So back to our first message. What kind of return can we expect? There are three pillars in every single investment decision that you make. First, it's what's happening, the economy. Second, the valuation, what is priced in. And third, at the end, sentiment, positioning, technical factors that move the market day after day. So the backdrop, we've said it, yes, we'll have a big global recession. We think 3% is what the global economy will lose. It's what the IMF says. It sounds reasonable. And we expect a recovery starting in H2. We are confident that the monetary and fiscal responses are big enough. We're talking about 6 trillion balance sheet expansion, $6 trillion in the world, never seen before, 4 trillion budget deficit in the US to fund this stimulus. It will be enough. So you could say, okay, you expect a recovery in H2, so maybe you should buy. The point is that what are the markets already pricing in? And this is where we have an issue. Valuations look optimistic. Markets have recovered. You have seen this be, and developed market stocks are a bit above what we think are their fair values. And I will elaborate a bit more on that. To take our decision, we build a scenario and then we calculate fair values. Where should the asset trade in our scenario for the end of the year. And this is what we use to do our allocation. Currently, the price-earning ratio of the S&P 500, the US equities, is close to 22 times, which is just almost an all-time high if you just forget the TMT bubble in 2000. So it's very expensive. Fortunately, there are selective assets, and I'll come back to that, where you have some opportunities. Third point, sentiment, because at the end, what moves the market is the buyers and the sellers. It's not just what happens and what is priced in. And to that extent, backdrop could lead us to be a bit cautious. Valuations could lead us to be very cautious, but sentiment leads us to be neutral. And let me tell you why. Everyone is bearish, and you can just talk to anyone. Your poll results were interesting because I could feel some more optimism in this distinguished audience to what we see generally. Everyone hates this really. Everyone will point out, yes, there will be a second wave and there is a mountains of debt and people are under invested. That's why we think you should be more neutral than slightly negative. So message number one, expected return, single-digit negative return, not a catastrophe. Second message is about flexibility. As I told you, there is volatility. There will be more because when you lift the restrictions, you have more infections. That's as simple as that. That's how it works. It's natural. We, even ourselves in the UAE, where the crisis has been managed incredibly well. You see the number of deaths per million inhabitants in the UAE is 20 times lower than in the UK. It's just fantastic. But even us, we've seen some restrictions are lifted and the number of new cases are slightly higher. So yes, people will be scared and say, oh, there is a second wave, there will be an even bigger recession. Another risk, we have geopolitical tensions rising between the US and China. Yes, it's an electoral year and Mr. Trump has to find someone to blame. So this will also create volatility. US elections themselves, what if Mr. Biden is elected president? Maybe would he come back on the huge tax cuts that Mr. Trump did 3 years ago, and what impact could it have? I'm just telling you that there are many risks. They are identified, and if you want to protect yourself from all these risks, it's simple. You don't invest anywhere. You just keep your cash under your mattress, and if you do that, you don't have any return. So what do we do for this risk? It's simple. We have a scenario. We calculate a fair value, and based on this fair value and what happens, if there is a risk, if it changes our scenario, we change our fair value. If it doesn't, we see if the assets are much higher or lower than our fair value, and we act. And this is what is on the right side on this slide. And frankly, I'm very proud to show you that. It won't happen to us every year, I'm afraid. But this year, what you see here, the volatile line in gray is the S&P 500 US equity index. And is it purple? Yeah, purple or dark line is our fair value calculated by Anita. So we started the year with a fair value on the S&P 500, and in February, our fair value was exceeded. Markets was higher than our fair value in February. So we told ourselves, we don't have any upside potential anymore. We have risk coming with this virus, so let's sell. And we sold, and that's what you can do when you have fair value. Then market collapsed. We calculated a new fair value, of course, because the scenario had changed with the virus. And then we found, oh, there is still upside. So we bought back the stocks that we had sold. And what we are telling you is, it's not that we will be able to do that all the time, but if you are a fundamental long-term investor with a kind of a cool head and some horizon, volatility is an opportunity. That's why our second message was to be flexible. Third message, favor emerging markets. I will be quick on this one because I'm afraid I'm already exceeding my time. Same framework. We invest given what happens, what is priced in, and what is the sentiment and the positioning. It's very simple. Emerging markets, backdrop, they grow faster. Look at that. IMF estimates, it's all the same source, that the US will lose 6% this year in its global economy, 6% in Japan, only 1% in emerging markets, and 1% positive for emerging Asia. They grow faster, better growth. Valuation, they are cheaper. The discount in price to book value between emerging market stocks and developed market stocks has never been that high. Just never. While the growth differential is in favor. There is something to be corrected over there. This is also true, and Satya will tell you, for the emerging market debt instruments, should it be Sukuks or bonds, where the risk-adjusted reward is better than in developed markets. Finally, is it crowded? No, it's not. Emerging markets are 40% of the global economy. They are less than 20% of the bond market and 10% of the equity markets. People don't own them. So that's something that has to correct. Now, you could tell me, this is beautiful, hopefully, very convincing, but it was true this year, last year, the year before, and emerging markets don't outperform. And it is true, because so far, emerging markets haven't outperformed, especially the US markets. Why should it happen? Because for emerging markets, we really think that the time is on our side. We don't know if it will happen now. We know that it will happen at a point, because on this slide, the question is, are emerging markets really still emerging? If you take a picture of the global GDP in 2000 and the GDP per capita in 2000 and in 2020, you can see the difference. Yes, 20 years ago, global economy is the top side was dominated by the US, Europe, and Japan. But 20 years later, see the size of the bubble of China. China is a big player, second largest economy. Same for GDP per capita. You had very different standards of living between the West, Japan, and the rest of the world in 2000. Look at how it is now. So if emerging markets are not emerging anymore, do they really deserve the valuation discount they have? We believe that not. This is our current positioning. As you've understood, the probability of good news is as high as the probability of bad news. We are neutral on cash, equity, fixed income, and alternatives, with clear preferences within them. We like quality in fixed income, and Satya will tell you more. We like emerging markets and growth sectors in equity, and Anita will tell you more as well. In alternatives, we believe in gold, because gold is simply the currency you cannot print. Last slide for me. I told you our mission is to protect your capital better than others and to be as good as them when markets are good. In 2020, as of April, it's the right part. Our three profiles are down 3%, 5%, and 9%, which is so far, alhamdulillah, better than competition. And with that, I will leave it to you, Mustafa. Thank you very much.
Thank you very much, Maurice, for very, very interesting and insightful session. And I love the way how you've taken all of these different variables and uncertainties and trickled it down to three key messages. The three key messages being single negative digit growth in 2020. Sorry, I think we're picking up some fluctuation. Sorry about that. Dua, can you please mute whoever's on this sound? Sorry about that, ladies and gentlemen. It always happens with webinars that at somewhere along the line technology does fail us. But basically, as I was saying, Maurice, excellent way of taking so many variables and trickling into three key messages. One, sorry, I don't think I'm going to tempt fate with that one last time. Single-digit negative growth in 2020, adopt flexibility, keeping in mind all the risks that we're going to be facing, and favor emerging markets. I think excellent overview of the investment climate. And with that, we can now delve deeper into the different asset classes. And before I introduce Anita for the equity strategy, we can now open up our second poll question and get the audience's view on that and link to obviously the equity strategy. So if I can ask the organizers to open it. And over here we want to know, which equity segment do you favor for the rest of 2020? And we've split this up between regions and sectors. And as we mentioned, you may favor multiple segments among this, but what I would say is that select the one that you think is most relevant, that is representative of your view and your expectations of what is going to perform well given the current market circumstances in 2020. And I would remind you, choose one answer, click the submit button so that we can record your answer. And if everybody has done that, can I please ask the organizers to open up the results for the second poll question? And I think the results would form a very good segue for Anita, who can then start her session. I think we're just waiting for the audience to finish wrapping it up and for the organizers to issue the results. And again, the question, which one of the following equity segments would you favor for the rest of 2020? And I am just waiting for the results to kick in. And not surprising, technology sector and the healthcare sector have the significant lead. Technology sector with 25%, health sector with 35%, and health sector with 32%. And it's not surprising given how all of our lives have changed that these suddenly become the two most important segments that everyone is keeping an eye on. And I think with that, Anita, I would hand it over to you to run us through the equity strategy part of the session.
Hi, good afternoon. I'm going to start by discussing the dynamics of global equity markets, the catalysts driving them, and what we expect in 2020. How do we position for the medium to the long term? So let's take a quick look at what happened in 2019. 2019 witnessed a stellar performance from global equities driven by a strong consumer and a low rate environment. 2020 began with elevated valuations, but it was the spread of the coronavirus epidemic that triggered the sharp sell-off in March. Lockdowns in China started in January, and that was the first major economy to slow down and has also been the first to pick up. The pandemic hit the US later, with the S&P 500 having the sharpest ever descent into a bear market, falling 20% in 11 days, and the quickest recovery ever, gaining 30% since the bottom on March 23rd. Equity market performance in 2020 has followed the pattern of lockdowns as business shutdowns directly impact economic growth and company profitability. Markets have, however, quickly recovered as record central bank monetary action has been supported, and more recently, hopes of a cure or a prevention. 2020, in some ways, is a continuation of the 11-year equity bull run that we have seen so far. Developed markets are outperforming emerging markets. Growth continues to outperform value. In line with what the audience has said and what we also like, the technology sector remains the best performing after returning 47% in 2019. The healthcare sector, which has been held back for years on account of concerns on government action on pricing, is now in focus as health is of paramount importance. Consumer staples with essentials being stocked is also in favor. GCC markets, however, have not yet followed the recent global rally, with economies still partially shut down and with low oil prices affecting government revenue and spend. So how should we position ourselves now? In which geographies and sectors do we see upside? As Maurice said, in the US, the S&P 500 is trading at 22 times forward earnings. That's well above long-term averages. Q1 earnings have fallen of the companies that have declared the results so far, 13% year on year. Investors are, however, looking through to 2021 with expectations of a 14% earnings growth in Q1. The consumer was key to the US equity rally of the past decade and contributes to 70% of the GDP. However, economic growth and consumer demand in the US is now being affected by unemployment, estimated at about 15% currently, and lower wealth. However, the US remains our preference in developed markets as it is home to the world's most profitable technology, healthcare, and consumer companies, which will ride the downturn much better than their strong balance sheets. The FANGs alone have over $500 billion of cash and continue to innovate, as do the mega cap healthcare companies which spend billions of dollars on research every year. We are underweight Europe, which has a low weight in the tech sector and a high allocation to banks, which face a direct impact from any slowdown in economic growth. Asian economies too offer a very attractive opportunity, as they should recover the fastest on account of the middle income cohort, which has growing consumption power, and also because of their young demographics. They are also the only economies estimated to have positive economic growth in 2020. Thirdly, we need to be selective, as the current rally is driven by multiple expansion and not backed by earnings growth. The timelines of resumption of economies is uncertain. We can debate a V or a W or a U-shaped recovery. Interest coverage and cash flow take dominance in selection of investments, as do the sustainability of businesses. Consumer dynamics are different in a world with lower demand for luxury items, less travel, less visit to public recreation facilities, and a wish to stay healthy. We see these three sectors as more resilient: technology, consumer staples, and healthcare, along with some specific themes in today's digitally connected world. So to come to fair values, partly which Maurice has already introduced you to, so we have estimated our fair values for end 2020 for the main global equity indices. Now these are based on price to earning multiples and earnings growth. We have revised down our expectation for earnings growth in 2020. We expect a fall of 10% in the US and 15% in the Eurozone. We expect flat to low single-digit earnings growth in the emerging markets. Emerging markets are at lower valuation multiples and presage higher earnings growth, and hence we see higher upside. The GCC is trading at higher valuations relative to emerging markets, and earning growth expectations are muted. Hence, investor returns will be driven by dividends rather than price movement. Fair values for the indices have already been met, hence the need for selectivity to add to alpha to portfolios. So do expect continued volatility and more opportunities even on the broad index level to emerge through the year. So why do we like emerging Asia? The mix of cheaper valuations, faster economic growth, and young demographics with an expanding consumer base provides high potential upside. India and China have a large millennial population, a large working class, and growing consumerism. They are also digitally savvy, though China leads on that front. Between them, India and China have 30% of the world's internet users. The world looks to India's middle class for growth opportunities. India's Reliance Jio has been in the limelight with Facebook's recent investment and also been followed by other global investment houses. India's 400 million middle class is seen to be resilient to the global economic disruption currently happening. Low oil prices also favor these oil-importing economies. China's advanced industrialized economy is driven by innovation and consumption. China remains the hub of the world's supply chain, though with global logistics affected by the current pandemic, we expect countries to focus more on domestic production of essential technology and healthcare components. China is also got a domestic consumption which is 75% of its GDP growth. It has also got homegrown market leaders in all the tech verticals, whether it is cloud services, streaming, or digital payments. China's consumer market is the world's second largest behind only the US. So to come to our own region now, the GCC and the UAE. So the key catalyst for the GCC market, and especially the UAE market, as we have seen, the markets have not rallied in keeping with what has happened globally, because we are still experiencing lockdowns, we are experiencing low oil prices, tourism has come to a standstill, as has airline travel. So what would take these markets up? Inflows from international investors and increased weight in the emerging market indices. Relaxation on foreign ownership limits is already underway. The Expo 2020, which has now been shifted to 2021, is likely to underpin growth. Low interest rates should provide a boost to businesses and consumers in the form of lower borrowing costs. At 0.65 times price to book, Dubai is at a 50% discount to broader emerging markets. Its dividend yield at 5% is among the highest in the world. Mergers of banks, as we have seen recently, ADCB, UNB, Hilal, are generating cost synergies. UAE banks are also very digital, which is very much in keeping with today's world, and are also adapting to the lower rates. What we are currently overweight in the UAE is the telecom industry, and the same goes for the KSA. There is increased use of data as consumers turn, as well as companies with digital challenge for everything, whether it is selling goods or healthcare, and even for social interaction. The GCC's consumers, as you can see with the chart on the left-hand side, are among the world's most digitally connected and very savvy. Low trading volumes remain an issue, but what we are seeing is there is increased diversification away from banks and real estate, which form a large part of the UAE's current capital markets. ADNOC is a very good example. ADNOC is also keeping in pace with what's happening globally and what is required today. They have just opened 4 on-the-go neighborhood stations in Abu Dhabi, which are smart technology-enabled stations that allow customers to shop at the ADNOC Oasis convenience stores from their vehicles through a drive-through. We are also seeing the economies adapt to the requirements. We have seen the KSA come out with a number of measures to address their deficit, and all this should flow through into improved economies and improved markets by next year. So how would we position? We've already discussed that. Maurice has also told you this. A number of catalysts are governing market dynamics today. There are a number of market drivers as well as a number of market detractors. What we would focus on is companies with resilient business models and systemic investing. Don't try and time the market. In a low growth world, we see investors focusing more on growth strategies over value. As you can see in that chart, quality and growth continue to outperform value over a 5-year period, and especially in 2020. For investors looking for yield, a number of companies in the healthcare and the consumer sectors do offer sustainable yields over 3%. We focus on sustainable because only companies that can service their dividend through cash flows are the ones that would be better for the long run. So let's look at what's changing for the consumers and what are the themes that we would look at today. So we highlight investment themes that have gained importance not only with social distancing, work at home and distance learning, but have also been the winners over the last 3 years. Genomics, of course, leads year-to-date returns, followed by the banks and gaming. But not only has brick and mortar, airlines and energy underperformed this year, they have also over the last 3 years generated no upside. So it's not that with the current change in consumer dynamics, new winners have emerged. There have been winners that have been there for the last 3 years, and we expect them to continue to be the winners going forward. I'm now going to talk about our 3 main investment themes for the year and going forward, starting, of course, with technology and connectivity and social distancing. So when we look at the technology sector, cloud services, e-commerce, high-speed processor, digital payments, gaming, streaming, automation are all seeing increased deployment with the demand, with the work at home and the study from home guidelines, which are going to stay in place not only in 2020, but for some time to come. And until a cure or a vaccine for the virus is identified. S&P Global Survey found companies expect to invest more in employee communication and collaboration technology on mobile devices and services. The ongoing digitization across industries will also lead to adoption of cloud computing as well as the integration of AI and machine learning. Automated production lines in food could be one of the biggest changes in countries as they emerge from lockdown. Flippy from Mio Robotics can cook burgers, chickens, and fries. Robots have been replacing workers in industries for years. Rising volumes have cut costs. In greatest demand are logistic robots with 176,000 sold last year. Warehouse tasks were easy to automate and relatively inexpensive. More technical jobs such as hospital robots able to assist in surgeries are more expensive and they cost about $500,000 per robot. So to go on to our next theme, which talks about healthcare and of course very important in today's world, given the highly contagious nature of the COVID-19, a vaccine to protect individuals along with effective cures. It's important for life to return to the way it was, and also important for consumers and businesses to gain confidence. Healthcare companies leading on the vaccine or cure or testing paradigm diagnostics will be in the headlights. Gilead is in the lead with its US FDA approving remdesivir, and the generic chloroquine has also been approved by other countries. On the vaccine front, which is accepted on account of new genetic therapies, there are about 80 companies with possibilities. Effective trials necessitate a wait for at least a year. Other healthcare companies ahead on the vaccine production or testing paradigm include Pfizer, AstraZeneca, Roche, Novartis, Johnson & Johnson, and many others. Also, what must not be forgotten is preventative healthcare with convenient and technology-friendly digital health solutions and telemedicine, which have gained traction during the pandemic and are going to be a core investment area for governments. US spending on healthcare is more than 18% of GDP currently and is expected to grow to 20% by 2025. And our last and a very important theme, of course, is food. Now, online grocery has gained prominence, as has the supply of essential food and its sourcing. Packaging, delivery, and logistics are now as important as the food item. With a view to building up immunity and maintaining good health, consumers are also focusing on healthier food choices. Companies already ahead on this paradigm are the beneficiaries: Nestle, Unilever, Pepsi, Danone, Beyond Meat, just to name a few. We have all seen the astronomical rise of Beyond Meat share price as people prefer vegan options. So, to conclude, there are plenty of opportunities to create alpha through investing in sustainable growth strategies. However, stay diversified and remember that systematic investing yields the best results. So back to you, Mustafa.
Thank you very much, Anita. And it was a fascinating presentation covering outlook on the US market, selectively looking at emerging markets, and the three selected themes or areas: technology, healthcare, and consumer staples. I think very, very well, very, very important for investors who are looking to see what is going to succeed going forward. And it's quite interesting to see that, when you mentioned that it's not new winners that are emerging, it's been the same winners for the last 3 years, really, showcasing that sustainability is what we need to chase in this. And ladies and gentlemen, I would just like, before we move to the next session, I would like to remind you to please keep sending your questions. We will be sharing your questions with the speakers and asking them, picking their brains and getting their insights on your queries. So please do keep that coming in the Q&A part. And with that, we would move to the last session of the webinar, and that would be focused on the fixed income strategy. And before I introduce the speaker, I would like to open up the poll question. And the poll question, obviously, not surprising, looking at US government bond yield as a key indicator for looking at the fixed income market. And the question is, the 10-year US government bond yield is around 0.7% today. Do you think this is very, very low, given the high levels of global debt around the world? Do you think this is reasonable, as it is a safe return and it's not in the negative territory at this point? Or do you think that this is attractive, as rates could further decline, particularly as this crisis, extends towards the second half of the year? Please select the answer that you think is most relevant and submit it. And I think, it's not surprising. We all know that it's going to be a low interest rate environment for the medium term going forward, but this will give us a unique insight as to where people think the current 10-year bond yields are and where they think the rest of the market is. So please submit your answers. And if I can ask the host to please share with us the results of the answer as well. And then that I think will give an excellent insight to Satyajit to then talk us about the fixed income strategy that our investors should be considering in this current investment climate. And I believe that they've closed the polls and they're just tabulating the results now, and they should be coming up on our screen any minute now. Again, the question was, the 10-year US government bond yield is around 0.7%. Do you think it is low, reasonable, or attractive? And I think 44% consider it to be very low, given the level of debt. That's interesting. And 29% consider it to be reasonable, and very few consider this to be an attractive rate, given that markets might go down to zero. So interesting results. And with that, Satyajit, I'll hand it over to you to go through the fixed income strategy part of the webinar.
Thank you, Mustafa. Welcome everyone to the fixed income session of this outlook. So how did we start 2020? We thought this would be a year of carry after getting double-digit returns in 2019 across various sub-asset classes in fixed income. We like GCC and Asia as a region. We hope that emerging market local currency bonds, especially the sovereign bonds, will outperform their hard currency counterparts. But then COVID-19 and oil price shock happened. It wreaked havoc with the spreads, especially emerging market and high yield spreads. Most of the spreads actually approached their peak of 2008 and crossed the highs that they had achieved in 2016 oil price. But thankfully, Fed intervened massively with monetary policy tools on 23rd March. That can be considered a D-Day. So Fed has three-pronged measures. One was to bring back sanity into money market, to jumpstart the primary issuance market, which had completely gone still, and to bring sanity back to secondary market bid-ask spreads. Was the Fed successful? We would think so. If you can see in the chart, the spreads have been tightening since 23rd March. Primary issuance market is back with a bang. IG issuance actually notched a record $295 billion bond issuance in April. And secondary market bid-ask spreads have been continuously coming down or tightening, at least for the IG issues. So what happened to our predictions? Of course, it's not the year of carry anymore, but we got 3 out of 3. Call it luck or the way market operates. The GCC debt has been very resilient as compared to its wider emerging market counterpart, backed by local investors. Asian high yield returns YT debt actually outperformed global high yield because they came out of COVID-19 earlier. And investors actually flocked into local currency benchmarks, sovereign benchmarks, because they considered them safe havens when the corporate default started rising up. Now, given this backdrop, where do we go from here? Our clarion call for the year is stay up in quality. The 10-year treasury yields will be range bound, and Fed has effectively put a cap. Even though we'll be seeing close to $4 trillion of treasuries being issued this year, the yield should not move up much. So sorry to disappoint everyone who answered A, but we do not think 10-year treasury yields actually moving up beyond 1% given the current scenario. And also there have been some talks about Fed going into negative rates. We do not see that coming in. I think, or especially we think, that the benefits would not outweigh the costs to the US economy and especially to the banks there. Global investment grade debt has tightened considerably in April, but still there is 50 to 75 bips of tightening left before the year end. That should give easily returns of upwards of 4%. Global high yield for the first time in several years actually justifies its name. But storm clouds are appearing in the horizon. You can talk about the US-China war of words increasing, or you can look at corporate defaults increasing. Actually, the corporate defaults number in the US have reached 50% of 2019 numbers and are expected to cross 2008 numbers. So that leaves us with emerging market debt and GCC debt. But is it just elimination of possibility that we end up with emerging market debt or GCC debt, or are there solid fundamental technical factors? Actually, there are 2 key catalysts: valuation and liquidity. If you focus on the chart on the left, which actually puts standard deviation bands, that means anything below 0 is actually cheap. Anything above 0 is costlier. You can see the shaded portion, which highlights emerging market sovereign, corporate, and Middle East sovereign, are actually the most undervalued fixed income asset classes. Now, what about liquidity? Thanks to Fed's generosity, there is ample liquidity in the system. And there is a tight correlation between emerging market debt spreads and dollar liquidity conditions. Thanks to this liquidity, which has now seeped to emerging market asset classes, we have seen emerging market debt spreads continue to grind lower. So these two provide a very good technical and fundamental backstop to take some opportunity place in emerging market debt. And that remains our long-term conviction. But emerging market debt is not a very homogeneous collection of securities. There is dispersion in rating, there is dispersion in regions. We have identified 2 key opportunities. First, closer home, we continue to like short-dated, A-rated, high-quality senior papers. These are plotted against an average A-rated dollar corporate yield curve. Anything above the curve is cheap. You can see that solid names like ADCB, SABIC, Saudi Electricity Co., Samba, Aramco, all of them which have robust fundamentals, which are not expected to deteriorate in the short duration, still trade cheap compared to the average A-rated curve. And with their spreads being 200 bips to treasury, we expect when things or sentiments turn, we will get some capital appreciation from these names as well. So the total return in these names could be upwards of 4% to 5% over a 1-year horizon. The second opportunity we see is in Asia, basically in the sovereign-owned entities of investment-grade countries. For example, an Oil India, or an Exim Bank, or Pertamina, or PLN. These are very strong names, and they are trading cheaper compared to the similar BBB rated USD curve. We don't think these entities or these sovereigns will be downgraded to high yield region anytime soon. These sovereigns have strong FX reserves, and any default by any of the sovereign related entities which actually be very detrimental to the access of primary market for these sovereigns. So they will not allow this to happen. And that gives us a comfort that with the kind of backing from sovereign, these entities will continue to perform well. All of them give you an yield of upwards of 4%. Look at 100 bips of spread tightening over the short duration, could easily end up with a return of close to 6% on these names. Now, these are the two opportunities. But in this scenario, it's good to focus on risks as well. So what is the key risk? Key risk that we would like our clients to avoid is exposure to equity-like credits. What we have done here is that we have arranged the various fixed income sub-asset classes from left to right in terms of their increasing beta to equity. So that means on the left side, we have very lower quality credits which have a high beta to equity, which you should avoid. And on the right side, we have high quality credits with a low beta to equity, which you should be overweight. For example, you should avoid EMEA financial subordinates, which are nothing but bank 81 perpetuals that have been issued. They might look very interesting in the current low rate environment, where the yields are upwards of 6%, they are trading below par, and coupons are upwards of 5.5%. But please remember that there are increasing risks of coupon cancellation, coupon reset, and call date extension risks. So you should be very aware of this risk before you actually go into such kind of securities. Now that actually covers a small overview or a brief overview of the conventional fixed income market. What is the situation in the Saqqaq market? Sukkuks have actually proved very resilient because of the nature of the investors. These investors actually do not trade Sukkuks. They buy it and hold it till maturity. But that has a con as well. When that reduces volatility, mispricing actually creeps in. For example, there is no reason why a Oman Sukkuk should yield lower than a conventional Oman bond of the same duration. Now, for this analysis that we have presented in both the charts, we have taken the whole Sukkuk universe. Its outstanding Sukkuks are around $136 billion. They constitute about 158 to 160 securities. Now, if you focus on the chart on the left, you can see that 70% of the Sukkuks are yielding less than 4%. So that means if you want to actually build a portfolio of Sukkuks, which will give you 5% or 6% return, you'll have to take more risks. On the right side, we think there is a maturity wall in Sukkuks between 2020 and 2024, when 40% of the outstanding Sukkuks mature. So we have to be very careful in credit selection. So given this backdrop, how do we build a robust Sukkuk portfolio? We advise the clients to follow barbell strategy. That is not just a technical jargon, it can actually be implemented as shown here. So on the front end, we advise our clients to actually clip the coupon. So invest in securities which provide you a high coupon so that you enjoy the carry and you get decent income. But credit selection remains key here. You should look at securities of issuers which are cash rich, which are sovereign backing, or have strong IG parent support. While on the long end, our aim should be to minimize volatility of the portfolio and to generate capital appreciation. How we can do that? By investing in securities which might be low yielding for now, but are investment grade and have a spread above 250 bips. So when sentiment turns, the volatility will be low in the portfolio and these spreads will tighten significantly, giving a reasonable capital appreciation. So that way, if you build a Sukuk portfolio, we'll get decent income, we'll minimize volatility in the portfolio, and we have a chance for capital appreciation. What more could you want? That is all from my side. Thank you for your patience and time. Hope you had an enjoyable session. Over to you, Mustafa.
Thank you very much, Satyajit, for that very, very interesting explanation of how we should look at the bonds in emerging markets, and specifically how we should look at Saqqaq and the discrepancies between Saqqaq and the conventional, and some of the unique insights that you shared. Thank you very much to yourself and to all the speakers for their inputs. And I think now we will go straight into the Q&A. And gentlemen, and Anita, I would like to just mention to everybody that we have a lot of questions to go through, and we are already running short on time. So if you could keep your responses as short as possible so that we can get through as many of the questions that is there. And I think the first question, Syed Umair, I'll direct this one to you. It's been asked by a couple of people, and basically, despite everything that, the team has shared, there's still lingering questions for ordinary customers about where and what asset class should they invest in. And specifically, they're asking about how Emirates Islamic can help them in, navigating through these turbulent times and making these investment decisions.
So I think to answer that question, at the end of the day, as Maurice started the presentation and talked about it, at the end of the day, we are not in the business of recommending a client to buy one security in one asset class in one region. As we talked about, one of the basic fundamentals of our business is diversification. Now, during the course of this session, first talked about by Maurice, and then Anita specifically on the equity side showed what are the opportunities for clients to invest in on the equity side on the global markets. And there are the three main themes she talked about: technology, healthcare, and consumer staples. And then following on the fixed income side, what Satyajit mentioned was on the opportunity on the fixed income is a very attractive opportunity we've not seen for some time, but cognizant to the fact that we need to ensure that we're investing in high quality credit on the shorter side and also on the longer side, duration wise. Now that is in terms of a summary perspective. Now, at the end, it depends to each specific customer, what is their risk appetite they're willing to take, whether they're conservative, moderate, aggressive, and what is their time horizon. How Emirates Islamic will work with these clients and help these clients to navigate that journey is that we have our investment advisors who sit down with the relevant clients, go through that journey to understand what is each client's profile, risk appetite, and needs, and based on that and the inputs we receive from the gentleman who talked in the presentation, is then a specific tailor-made portfolio is recommended to each specific client. That's what our journey is, what we've been doing, and that's how we believe that is the best way to capture the concepts of diversification and the recommended strategies mentioned by the presenters here. On the execution side, how Emirates Islamic helps its customers, at the end of the day, on the execution side, we're able to build fixed income portfolios on the Saqqaq side for our clients. We have a list of funds on our platform which are able to execute on some of the strategies what Anita and Maurice had mentioned in their sessions. And lastly, we had recently launched 3-4 weeks ago our global equity trading platform whereby our clients can trade in global markets, the US markets, the UK markets, the Japanese markets, on individual equities, from which they, on the back of that, they can build portfolios which are recommended and suggested by Anita and our team. So in a nutshell, those are the ways on which Emirates Islamic works towards helping their clients, and what are the specific asset classes or asset allocations clients should be holding at the moment.
Sounds good. Expert insight and guidance facilitated by technology to help you execute on your strategies. That sounds very, very interesting. I think just leading on from that, Anita, there's a couple of questions that came in related to equities. One, not surprisingly, asking about your perspective on UAE-based equities. And I know that you covered a little bit of this in your presentation when you covered GCC outlook, but if you could talk about that. And another asset class that they're asking about, or not asset class, sorry, another sector is the aviation sector, airlines. And given the current crisis, is this a temporary blimp? Is this going to be a long-term blink? What is the perspective on airlines as a sector within equities? If you could briefly touch on both.
Okay, so Mustafa, so just to on the UAE, I already gave the clear catalyst. So at the moment, the UAE markets look very attractive because valuations are low, and you've also got a very good dividend yield. However, there are three forces in play against UAE equities. First and foremost, the most important is low oil prices because UAE government spend is driven by revenues that come in from oil. Dubai less so, Abu Dhabi more so. Also, you've got tourism at a standstill right now, which affects the Dubai economy and the businesses. Also, you've got airline travel also at a standstill. So, with this, keeping all this in mind, even though valuations are attractive, even though the dividend yield is attractive, we haven't seen too many companies cut in 2019, except for the real estate sector. But since the index is largely weighted by a combination of banks, which are obviously bearing the brunt of low interest rates as the rest of the world, real estate sector, which is seeing some oversupply, we would wait for the catalyst of increased, investment from overseas as well as, an increase in weight in the emerging market indices. So we see higher trading volumes before we were to add substantially. What we really like at the moment is the telecom sector, good dividend yields as well as benefiting from data. So to go on from there, what's corollary is the aviation sector. At the moment, we are not seeing any major upside in the aviation sector, even though there have been large bailouts given by the government, even though airlines have slowly started, resuming operations, especially in Europe. But we do not see air traffic coming back to the levels that it was, and the airline companies are heavily indebted. And our stance in the CIO market has been very clear from the CIO office is that please go along the quality paradigm. Please invest in companies which have low debt, which can service their debt. As we don't see airlines generating enough cash flow to service their debt easily, we would stay away from airlines right now.
Very interesting. I'm trying to get through as many of these as I can, and there's a lot of questions coming in. So, Maurice, two questions for you that have come in from two different participants. I'll tag them together. One is, obviously, investors in this region love real estate. So the audience wants to have, your perspective on real estate as an asset class for their investment portfolios today. And the second question is around emerging markets. And do you feel, or is it the view of your team that emerging markets have the same backstop and central bank support that developed markets do? So your response to both of these. Maurice, if you could please unmute yourself. I think you're on mute.
Yes. Can you hear me now?
Yes, we can. Yes, we can.
Oh, okay. So, sorry for that. So, two very different questions. I will start with the real estate one, and we're always very transparent. I will make a distinction between our local real estate and the international real estate, because our local real estate, we are in a situation of oversupply. We believe in the long-term story, but frankly, for the coming 1 or 2 years, there is not much to expect, and I cannot be more direct than that. Again, we believe in the long-term story, but the short term is challenging. As regards the global real estate, it's very interesting because global real estate has two features. It has a defensive feature because you own something, it's not virtual, and you get some rent, so you get some yield. But it also has a cyclical feature because if you rent to companies and companies are in trouble, and Satya told us about the bankruptcies that are happening, you don't get your rent and everything goes down. I must say that we are currently slightly underweight in global real estate because if you really believe in the cycle part, you can have opportunities in equities, and if you really want something defensive, Satya finds better opportunities in the Saqqaqs in the region. Now, the second question, and you told us to be short, I could write a book on that, hopefully. Emerging markets, the backdrop, and the central bank support. Of course, it is very different, and frankly, life is simpler when you are the United States of America, and that you can suddenly create $6 trillion like that. Life is simpler because you can have 4 trillion budget deficit. Can be $4 trillion of budget deficit this year. It's not an issue. The entire world wants US dollar. You can print them. That's something that others don't have. The ECB has it, the Bank of Japan has it, but arguably nobody wants yen except the Japanese. It has some defensive features. So when it comes to emerging markets, just 5 years ago, it was unthinkable for them to use their central banks to support the economy. It was unthinkable because it would have had an impact immediately on the currency itself, and they couldn't do it. But now things are changing. They are going this route. China is going this route partially, but there is a balance sheet expansion. They also have reserves. We have seen India, Colombia, Brazil recently has cut rates, which is something that they would have never done 2 years ago because the currency is vulnerable. But you have no choice. You have to support the economy. And if everyone is using the central banks in the same way at the same time, then the impact on currency is lower. Having said that, and maybe to conclude, the difference between DM and EM is that EM, they have this strong secular long-term driver of improving the GDP per capita, and for China, it's a transition to more internal consumption. For India, it's a matter of, going from 4,000 GDP per capita per year to maybe 8,000 or 10,000. China is 15, 20. The US is 80,000 or the UAE is 80,000. You have these drivers. So it's a better quality of underlying growth. The US might grow. One day, maybe the central bank will print a lot of money to fund a big infrastructure plan, which could be the new deal of the US, which would be consistent with the idea of having the supply chain, back to America. We could see this, but that's built on debt, on an old economy. And we're not saying that the US will go nowhere or in recession or whatever, but the long-term potential of emerging markets is much bigger. And in the short term, they have some support from central banks. I've been too long, sorry.
No. Very, very interesting response, and I'm sure that's exactly the type of feedback that the questioner wanted. Satyajit, I realize I'm running through these fast, but I'm going to come to you for the next question. And there's a question that's coming up regarding your outlook on sovereign bonds and sovereign Saqqaq issuances, and specifically regarding the potential risk of a default or a haircut. So if you could just quickly comment on that and what your perspective is.
So you can divide the sovereigns in the emerging markets into IG and HY players, right? So in the IG market, I do not see any imminent risks of default. So sovereign solvency is not an issue. Most of these countries have large FX reserves and have strong domestic economies. They can weather this storm. But it's a different task when it comes to HY sovereigns. Let's, for example, take into consideration the GCC HY sovereigns or the MENA HY sovereigns, right? There is Egypt, there is Bahrain, there is Oman. So Egypt, for example, so there are different intricacies you need to go into detail for each and every economy. We cannot just blanketly say that all of them are risky or all of them are not risky. For example, an Egypt, which is not dependent on oil exports and maybe perhaps a little bit of tourism, which gives 12% contribution to their GDP, is much more stable in current environment as compared to Oman, which has got a large fiscal deficit and which would require some kind of support, according to a lot of analyst estimates, in the next 3 to 4 year horizon, once it runs through its FX reserves to fulfill its fiscal deficit, right? When it comes to frontier markets, for example, take it as Sri Lanka or African sovereigns, for example, right? They have a lot more issues. They do not have the FX reserves that have been built up over the years, like Oman or Bahrain. And currently, they are running large fiscal deficit because of the economic shutdowns. They would require some kind of compromise with either the bondholders or IMF has to come in to support them. Without that, I believe it will be very difficult for the frontier economies to sustain. That's why we have been telling that stay up in quality, even in sovereigns, only go for IG sovereigns. The yield might be lower than the frontier names, but there'll be a lot less volatility and there'll be a lot less hard burn at the end.
Thank you so much, Satyajit. And, obviously, what you're saying makes perfect sense in that every single, market has to be looked at selectively to determine that. And this is why, we have advisors like yourselves who can guide investors through this, challenging environment. So, Maurice, I'll ask the last question to you, and literally 30 seconds. We had two questions here that I thought I would just ask. One is, we talked a lot about emerging markets, but we didn't really mention Africa as such. And what is your perspective on Africa vis-a-vis other emerging market regions like we've discussed, China, India, GCC, Asia, and others? That's one, very, very quickly. And then the second one, to close it off, a questioner asked about investment in gold versus equities. And you mentioned, gold as a safe haven asset in your presentation. And, obviously everyone encourages diversification, but if you want to briefly comment on that point and to close it off, over to you.
Thank you very much. I hope I'm not in mute anymore. No,
you're good.
We are beginners in webinars. Well, Africa is no doubt it's the next frontier, but we don't know when. It's as simple as that. As long as we currently have and see opportunities in the most developed part of emerging markets, let's say the China, of course, the emerging Asia, which is running ahead in the story, we see opportunities there. So we don't spend lots of time on the most frontier, the emerging part of this universe. The time will come, but unfortunately, and that might be unfair, when you have this kind of big macro events, it delays a bit the time when it will change. Africa has many assets, huge growth, and I think it's more a private equity story now, project by project. I understand when Majid Al Futtaim, when they open their Carrefour stores in Africa, they are doing fantastically well. It's more this kind of things that having investors going into local shares now. Unfortunately, it could be different if we had a PE of 20 in China, but that's how it is. Second question, gold versus equity. You know what I'm going to answer. You have to have both because clearly gold will not give you yield while equity will give you an exposure to growth, and equities are you really have to have both. Gold is good when you have big shocks and when you have big inflation. One day, all these trillions that are written, we might come back in the form of inflation, of its currency debasement, and that's the time when you would like to have gold, and maybe even things like cryptocurrencies that we'll have to look at a point from an investment point of view. Probably too early, like I was mentioning Africa, but at least you have gold now. Gold is good against inflation and against shock. Equities is the exact opposite. If you have growth, the opposite of a shock, it's what will give you your return. It's not that much in the fixed income. We live in a low yield world, as Satya has described. It's also a call on human, activity, initiative, reactivity. Anita has highlighted the winners of the current situations. They are. The Nasdaq is positive year to date in 2020. Can you believe that? Yes, because they provide solutions. And finally, if you have a low inflation, low positive inflation regime, equity are a nominal asset. The turnover, the total sales of a company, and the profits, they integrate inflation. So you really have to have both, but currently please don't forget to have gold.
Sounds good. Thank you very much for that. And I think with that, we've ran well over our time, but it's been a fascinating session. I would like to thank all the speakers who attended today, and I would like to thank all the delegates as well. And I would like to remind you that we will be sharing a video recording of this webinar. So if you missed any part of it, or if any of the content, we know we went through a lot, if you want to go through it again, then you can do that in your own time. With that, I would like to thank you all very much. And I hope that you all remain safe and your families remain safe in this difficult time. And we hope to see you again on our next webinar. With that, Assalamu alaikum and have a good afternoon. Take care, everyone. Bye.
Thank you.